just a basic disclaimer or general advice, just to let you know that anything we do cover today is for educational purpose and doesn't take any of your objectives into consideration or financial background. Now, before we can answer that question, we just need to define what the golden cross is for those who are new to using these indicators or technical analysis for that matter. Now, what you're seeing on the chart here is the XJO, the ASX 200 index. Now, for those who are not familiar with actually the golden cross, it's simply a moving average. Now, what is, first of all, a moving average? Moving average is the average price, in this case the closing price, over the last 50 days. So we add up all the closing prices for 50 days, and we simply divide it by 50. Now, the green one is 200 days. So what it means is that we're representing a medium term. 50 days is a bit over 2.5 months or 2.5 months. 200 day represents almost a year price. So this indicator, what it's trying to determine is what is the medium term, which is 50 days, trend is like compared to a 200 day. The 200 day is the green one. So the golden cross occurs when the 50 day crosses over the 200 day, which is the green line. So you've seen it on the financial news, you hear people talk about it. Does it actually work though? I mean, are they just simply using it because everyone else uses it? So to be able to determine that answer, we need to apply a set of rules. So the simple rules for the 50 day, for the golden cross is, they say trend is up, which means you want to be buying when actually the golden cross occurs here. So somewhere around 6,225. And you want to do the opposite and close or get out of your position when you have the death cross, which is the opposite, when the 50 day crosses below the 200 day. So that means that there's our condition to enter. We buy when that occurs, and we sell when that occurs. Simple as it. Simple as that. So all we need is, when do we enter? When do we exit? Now, the basis for these tests is, we don't want to just test it on the index, because it doesn't really tell us much. It gives us an idea, but really want to test it on is a basket of stocks across different sectors and different time frame. So we don't just want to test it during a bull market. We also want to go through during the GFC and test it out to say, does this work? Does this work has two parts to it. Will it make money? That's really the question. The other side is, not only do you want to make money, part of making money is to not be in the market when the market is down, to prevent losses is the best way. So you want to be in the market when it's trending up. At the same time, you want to be out of the market when it's trending down or in a bear market. So now we've established what the moving average and our conditions for our test. We can now go and apply this. So we've now put this rule and conditions into a strategy for testing. So if you have a software that allows you to do some testing, you can do exactly the same. So we just want to establish what would be the results, the combined overall results across our basket. In this case, we're going to test all 200 stocks on the ASX 200. Now, in some cases, if they've been around less than 200 days, which is under a year, they won't come up on the testing, of course. However, overall, we'll get a number of this occurring, and we can then add it up and get a statistical result of whether this overall, are we profitable, and then we can take a look at some examples of when this occurs on the individual stocks, particularly stocks that most investors may have, like banking, Telstra, which we'll go through. Now I'm going to run this test. Before I run the test, let's get some basic money management in play. We need to allocate some money. To make it simplified, we put in $1,000. So each time when that occurs on a stock, we'll buy $1,000 worth of stock. And then we simply exit, remove the whole amount. We won't add back into compound. It's simply every time $1,000. And then we table the results at the end. We don't put brokerage in, we want to test the baseline. And then we'll get a good understanding of where this strategy or this idea itself will work. So whenever you hear any idea, particularly when it involves technical indicators, make sure you test it, because some ideas may sound good, but they may not hold up at all. Remember, we're testing the past, that's all we can test on. But it'll give us a good indication of how the markets behave, because if we test it over from 2008, let's say before that, we've got bear markets, we've got bull market, we've got sideways market, we've got all the major conditions you would expect, and you want to be testing all those environments. Because simply to test in the bull market will be misleading. You're picking the most favorable condition. In the last 10 years, for example, every investor is probably brilliant. You could be a blind monkey and still make money if you held over that duration. But what you really want to know is how sound is the strategy during a bad market, or let's say it's not bad, but market that's not suitable. What the strategy should be doing is to go into cash, which we expect this to do, because this strategy itself falls under momentum. So the basis of a momentum is simple. Buy a stock when it's trending higher and sell it when the trend bends or the trend turns the other way from uptrend to downtrend. So you would expect it to lose some money when you're in a bear market, but you won't have many opportunities. Most often, it will just shut down. You'll go into cash 100%. And when a new trend emerges, you'll get back in. Now, with momentum trend strategy, the most you would get, you will never get 100% of the run. Meaning that if you have a bull market that runs for 3 years, you at best, you would generally capture 70% of that trend, because you won't be able to pick the tops, you won't be able to pick the bottoms. What you will be able to get is it somewhere in the middle, somewhere around 2/3. So there are examples of me highlighting that there. So that trend started from the bottom of 2003, and you can see the top up here. Now, what we want to capture typically is this amount, that 70% move. So between that point and there, never the top, never the bottom. But most important, when the market goes down or we get the direction wrong, we cut losses and we get out quickly. So I'm going to run the test now. It's going to take a few minutes. So to save some time, I'll just run you through some of the statistics and we'll extract them. We don't need all the information. For a lot of these charting and testing softwares, you get a lot more than you need. What we really want to establish here is the total net profits here, this column. We also want to know our average risk to reward in terms of how much we made compared to how much we lost. We also want to table the total trades to get an idea that we're doing across not just 10 trades, but the bigger the sample, what we call sample size, the bigger the, you could say, robustness of the strategy, meaning it's not tested on only 10 times or 10 entries and exits. You want to have more. It just gives you more sound. It's like doing surveys. You want to survey 1,000 people compared to only 20 people. We want to know how big the average profit was, how big the average loss was. At the same time, we also want to know how often will we write our winning percentage. So now we got all those information, which what I've done to save time, I've just extracted this information that we need onto a spreadsheet, and now we can do some calculations. So there's a symbol, a column, there's the net profits, there's the winning percentage, the average loss, average winning trade, and how many trades in total. It's important to gauge that as well. So let's break this down and go through one by one, and then we can answer that question we first asked, does this work? Now, that, as I said, it has two faults, but the general question is it profitable? That's what we're really asking for. Now, we've averaged up the winning percentage. So each individual stocks, each percentage on how often it was right, every time it took the trades here, gave us a percentage. It averaged, surprisingly for a lot of people who expect some big numbers, it's not above 50%. So 4 out of 10 trades were right. Now, this is where the important part comes in. Now, the next part is, let's do the losses first. So when we were wrong, how much did we lose out of $10,000? Now, obviously, we want to keep this as small as possible. And that worked out to be an average loss of $104. Now, in context, that's a 10% point. Just say 11%, we'll round it up. 11% loss on the $10,000, $1,000 account position allocation. Now, this is the important part. Now, when we did make money, Remember, the basis of trend momentum strategies and trend strategies to let profits run. How big was our profits, relative to our losses, remember? So we made an average of $752. Now, take that as a percentage gain from the $1,000 we put down. That's a 75% average profits. Now, have you had any strategy that you do or that you're currently using giving you this sort of number? That's quite large. So that means that you'd be holding, on average, you're going to be holding these things. We won't cover this today, but statistically, you're going to be holding much, much longer. And when you're wrong, you cut your loss, so you will be in the stock maybe a month, 2 months. A lot of people tend to hold it when they've got losses longer, which they're doing the opposite. So that's how you can get this number. You must cut this quickly, losses, and you must allow for the profits to build up. Sometimes you're going to be in the stock for 3 years, maybe longer. And you need that in order to be able to give you some good profits at the end of the year or several years. Now, by doing that, we can then say average out these two, and that gives us what we call average win-loss ratio. So simply what this ratio means, we average $752. We only an average loss of 104. We divide the 752, and we divide it by the $104. So that gives us a number of 7.21. However, we were only 40% right, so we need to adjust for that. There is calculation for it. The simplicity of this actual video, we now adjusted for the 40%, then it gives us this final figure down below. Now it's called profit factor. You can also call it risk reward. So it simply means for every dollar that you put down, you're making 5.12 back, $5.12 back for every dollar. The higher the number, the better it is, of course. Now, to give you an idea of what this looks like, this is not allocation, so you obviously can't buy. Well, you can, but you won't be buying 200 stocks in the portfolio. You won't be allowing for that. You may be allowed for 20, 30. So just to give you an overall, because the old saying, a picture is 1,000 words. So this is what it's like if you look at it from a general big picture. Now, you would expect, now this is closed, which means at the end, you are not showing what's open, which means any profit that hasn't been realized is not showing. It's only showing what's being realized. So why you're seeing 2008 was profitable? Because what we opened up in 2006, even before that, got closed out in 2008. Because when the market turned over, we got out and we realized the profit. And then we went through a period of losses because you're out when the market turns down. There's some opportunities, not many, and you go flat, which means you shut down. We go into cash, which is why you're seeing this flat period. And then the new trend emerges, and then profits start to be realized again. And that's exactly what you want to do in your own strategies, that when you go through a bear market, unless you're happy to sit through 50% like a drop in the account like the GFC, markets go through cycle, and we're probably very close to the next major downturn. Don't know what will spark it, but certainly anything can spark the market in this current environment. Regardless, you never find markets go up always. This is one of the longest bull markets we've had in 50, 100 years since the market's been traded by investors. So you can see over time the account grows because you allow profits to run and you get out of the trends when it's not emerging. Most of the time, markets aren't always trending. So most of the times you might get a flat trend or a downtrend. And when the markets do trend, by simply doing this, you will always capture those trends because you're constantly looking for those conditions. Now, to show you some of the stocks examples, let's take a look at an AMP because I know a lot of people have looked at it, and I had people ask about, should I buy AMP? Now, the word cheap is very misleading. AMP could get cheaper. Now, this is updated for not today's, but yesterday's, $2.17. Now, the green background means that we had the golden cross. Trend is up. Whenever we don't have those background, I mean, it's opposite has occurred. So you can see it would have prevented you getting into AMP from about $4.60, which is about here, and you would have stayed out until we see this cross. So it's still saying the trend is down. Can AMP fall further below $2? Certainly can. And it's not impossible given this context I don't know what's happening in detail with the company, but it tells me one thing from the buyers and sellers point of view. There's more sellers now, and people are selling this. Every time it went back up, pushed back down. Now, you could buy it and think, oh, it should be bottoming. It's possible that this could go down below $12 and maybe go bankrupt. We don't know. However, by using momentum on your side, you have a far better chance. Why would you not buy a stock that is rising compared to one that's falling? Now, long-term investors might go, hey, this is a good buy. But you run a huge risk by catching a falling knife. This is buying a falling knife here. Would you rather buy it when it actually shows signs of life and buys it come back in like here? Would you want to buy that instead when it's showing that momentum and buys are actually on the right, you're on the right side of the general market? Why do you want to fight the market? That's my question. Now, some people go, okay, it's fine. It just means that any strategy you run, just as long as you know whatever you're doing and you have an exit plan. So the whole concept, you can see, every time that we have a major downturn, we stayed out of it. Because why? Price is telling us that sellers are in here and they don't like this stock. That may change, but whenever that changes, then you can buy it. Would you rather buy it when it's on the way up than on the way down? Now, if you average costing, as I said, you run the risk. Long term, it may work out, but I'd rather not be stuck in the stock for 5 years before it can recover. And AMP, if you look at his history, if you bought the dip long term, you would have been worse off. It started, if we go back to the beginning, it peaked at $11. It's now at $2.17. So if you average dollar cost average all the way here, you're still down, unless you're buying a lot more now. However, it doesn't guarantee that. It could still go down lower. And there's a lot of cases where stocks have done that, and people thought it's only down short term, fundamentals look good, and the stock keeps going down, and eventually it goes bankrupt and closes shop. So my point is that part of the strategy is not only to make you money, but prevent you losing money. So like here, that was a good time to buy. This was probably a break even, but in general, not only good time to buy it, but certainly a good time to be out of it right here. That's a 50% decline that you missed, that you would have prevented yourself from losing. That bottom there was a larger decline. If we go all the way from here, that's a 70%. Let's have a look at the price. That's a 67% decline from the top to the bottom. Huge. Where you would have saved 50%, 1% of that, but just by waiting for this to occur. Now, as I said, you won't get the bottom, but certainly you won't have to sit through all this. Let's take a look at Telstra and we'll look at one of the bank stocks, and that will cover examples of it. But the key thing is here, we buy when there's strength, when there's buys. So this is Telstra. Now, those who've asked about Telstra, it's a good time to buy. Based on this golden cross, you would have been in it. And you would have been in it from about $3, just went close, about $3.20. So you're up about 60 odd cents. And who knows how long Telstra will run. Maybe this could be the safe haven stock to buy into, utilities. Looks so far that way. Buyers are coming in, and it had a bottom in around June 8, 2018. However, look at this. That's the opposite side people forget to look at, is you didn't sit through all this. That's the 40% you would have avoided you. Probably down here a bit more. From this point, actually, a bit more accurate here. So you can see that's about a 38% that you would have prevented the headache of sitting through this stock, and then obviously here. And you saw in the statistics, you're 7 times, you average 7 times when you make money compared to when you lose it. And that's for that reason, because you're not in periods when it's not suitable, or you have low odds of being successful. Now, you wouldn't call this trading, because this holds for years in some cases. So you're not talking short term. We're not in and out a month or two. We're talking sometimes 6 months, even up to 3 years in this case here, from 2011, 2015. So sometimes these big trends can unfold and can result in profits that can be up to, in this case, almost 100% here. So that's 110% there. So the most important thing about it is sitting on the sidelines when your trends emerge. And that's part of the rules that allows you to do that. Only until when this occurred, then you get out. We'll look at the bank stock and we'll wrap this one up. So CBA, I'm looking at CBA because a lot of people own CBA. It's a very common stock. But I'm just trying to highlight exactly the same thing. CBA has had a downturn, or has been sold off. Really, if you look back in this since 2015, it's had a peak of around $96, and it's struggled to get back up there. Now, you can see where I've marked here. There's been times where you don't want to be owning CBA. We're talking almost a year where it's gone down. Now, you do pick up the dividends. Some will go, I like the dividend. That's fine. However, if you could even prevent that, the dividends would not make up for the total loss that you made here. It's 12% decline you saved there and on the way down here. So clearly what I'm trying to illustrate here is that by using momentum, which is what the Golden Cross as a strategy is trying to do, it puts you on the right side of the market more often than not. In this case, 40-odd% of the time. However, when you're right, the payout is really big. That's the key. So cut the losses, let your profits run. That's really the basis behind momentum, Golden Cross. Any strategy that works on price, action, on trend, that's the aim of it at the end of the day. Anyway, thanks for joining me this video. Hope that's given you some insight, and maybe you can do some of your own research. Certainly don't believe this blindly. If you can, do your own research and form your own basis of opinion. But the facts are obvious, is there. When you see the numbers, it allows you to say, okay, yeah, there's something more to it than just them talking about in the media. And once you build that up, it will allow you to have the confidence to start doing these strategies and applying just the idea of using a factual-based, research-based driven decision-making, and have rules centered around what you do when you buy and sell. Because a lot of investors and traders I know have very little exit strategy. They get into stock, get in trouble, and it can cause them big losses. A small loss that turn in from a 5% loss to a 90% loss and blow up the portfolio because they weren't managing their risk. Because momentum allows you to automatically build into the strategy, cut losses, let profits run, that is the key. And again, thanks for joining this video, and I'll see you on the next one.